Welcome to our series, Moving America Forward. Each week we'll be focusing on America's entrepreneurs as they take us to new roads, new opportunities, new ways to fill the gaps left by today's failing companies. Our series will be looking at that and a lot more. So come with me and watch as the entrepreneurs of our nation move into the future.
And I'm Doug Llewelyn here in our studios in Los Angeles with our guest today, who is a fascinating gentleman. His name is Dr. David Yeh. He is a nuclear doctor, a nuclear physician, meaning a radiologist, that kind of a doctor. He's also an author and an investment advisor, and he has a fascinating story to tell. I'd like you to meet him now, Dr. David Yeh from Naperville, Illinois. Dr. Yeh, welcome. Nice to have you here.
Nice. Thank you for having me.
As I say, you have a very fascinating story, and we're going to get into it in depth. But first, a little while ago, you had a chance to answer some questions from William Shatner. Mm-hmm. Let's take a look at a brief portion of that now and see how it went. Okay? Right. Watch.
I know you've been successful in your business, but what I would like to hear is just a brief capsule of exactly what it is you do and who do you do it for, and how do you see this helping America to move forward.
Mr. Shatner, I formed the Wealthy Doctor Institute to help colleagues and other professionals who don't have time to invest. I myself have developed investment strategies for the past 20 years, which has helped me semi-retire at the age of 45. Now, I pass my knowledge and experience along so that I can help others save and invest for their retirement. And that, Mr. Shatner, is how I help move America forward.
You know, that's very fascinating what you just had to say to Mr. Shatner. I'm sure many men watching the show, and women as well, would love to be able to say the same thing you did, that you were able to semi-retire at the ripe young age of 45. I have to ask you, how on earth were you able to do that, considering the fact that as a nuclear physician, you've already spent half of your life in school for the most part, right?
Right. In fact, up until medical school, I was in school. When I had my first paycheck when I was an intern year, I thought I knew how to manage money, and unfortunately I didn't really have much life experience at that time, and I quickly learned how little I really knew until the time when I ran myself seriously into debt and I was just miserable. I ran myself to a point where I vowed to myself I would get this part of my life handled. So this is when I started reading about personal finances. I started reading about how to trade. As a nuclear physician, as a radiologist, we were trained to do pattern recognition and quantitative analysis. So I used skills from my profession to apply to my investment strategies, and that's how I developed my strategies over the years.
So this was, you're still an intern when you began this study?
Yes.
And then you continued studying and reading, and then you started practicing what you were reading. In other words, you began investing at a fairly early age.
Exactly.
And you created your own technology on how to invest, or your own formula on how to invest. And I guess the bottom line is it really worked for you, because by 45 you were able to semi-retire. You actually you quit being a radiologist, right?
Well, I semi-retired.
Okay.
And that's because I originally became a doctor because I was very interested in what I was doing, and I'm still able to help patients, just not at a level where it drives me to burnout. And the technologies that I use to invest, they're not new ideas. I synthesized several common ideas into systems that worked for me. And as a busy professional, I couldn't spend hours watching the markets. So what I did was, the systems that worked for me, I only had to monitor once per month.
Well, that sounds pretty fascinating. But before we get into that in depth, let me just ask you, what was your life like as a radiologist, a nuclear physician, that would cause burnout at a fairly early age? Tell me, just briefly describe what it was like that you were doing.
Well, the good news about radiology in general is that we're very useful. We can help diagnose patients prior to going to surgery, for instance, or prior to chemotherapy. But as people age and become more and more complicated, the scans became more complicated. We started to get more and more scans, particularly on call, when we're alone looking at these stroke cases now that are very complicated, and just being on call over and over again takes its toll.
I mean, basically your life was reading on television monitors the results of MRIs, CAT scans, and things of that nature, looking for things that doctors could not find with the naked eye, right?
Right.
And it's very wearing on you mentally, because you know their lives are in your hand. If you don't pick up what's wrong in that picture, it could mean life or death for the patient, right?
A typical CT scan or MRI can have hundreds of images, and if the diagnosis is on one image and we miss it, that could have potentially catastrophic consequences.
Well, to get back to your primary reason why you're here is because you did retire, and you have founded your own firm called the Wealthy Doctor Institute, which is a great title, the Wealthy Doctor Institute, and you've written a book. And this is the doctor's book. It's called The Busy Doctor's Investment Guide, and it's all based on his theories of investing and what he has done to enable him to be able to retire. So let's talk a little bit about that. Sure. And by the way, doctors are notoriously supposed to be poor money managers. Isn't that, in general, the reputation they have?
Unfortunately, that is true. We've had, for instance, whenever colleagues had a stock tip, for instance,
right,
they would do stupid things with it. I've had colleagues who would either be ultra-conservative because of relative ignorance about how to invest in general, or they would be more cavalier with what they were doing and not realize that whenever they invest, they need to know when they're wrong.
Well, tell me a little bit about what your system is like and what you've written about. What is the book all about? Obviously, it's your system, isn't it?
Yes.
And it's not a thick book. How many pages is it? This is, it's about 38 pages, somewhere 140 pages, somewhere in that neighborhood. Is it complex to learn?
I try to make it as easy as possible because my systems are inherently easy. In fact, when I first semi-retired, my colleagues started to take notice and ask me how I managed to do what I did, because I seemed pretty young. And when I tried to teach what I thought was pretty easy, people started asking me, well, they hinted if I could write a book so they can have something to refer to. And once I wrote my book, I went over some of the theories behind what I did, how I developed the theories, and the psychology that we need to adhere to be able to invest effectively. Because I find also one weakness that a lot of investors in general have is that once money hits the markets, their plans go out the window. So this is when, if they don't stay disciplined with their plan, their investments can go awry.
Then everything goes wrong.
So I try to make my book as simple as possible, try to make my teaching as simple as possible. And despite that, even after I wrote my book, people started asking me if I would invest for them.
Yeah, I'm prompted to ask you, are your theories on investing different from most everyone else who's out there telling people how to invest and what to do with their money?
Well, I have some ideas that are similar to traditional money managers,
right?
The modern portfolio theory, et cetera. However, there are risk mitigation strategies from traders, active traders, who look at stock charts that I incorporate with portfolio management.
One of your theories involves you have a set level. If you have stock or whatever it is the investment is, you set a barrier. And if the stock or the market even goes below that barrier, you get out.
Exactly.
Right? Entirely.
Exactly.
Whether you've got 20 stocks or 50 stocks, you sell them all. Is that right? Or is it just the one that goes down?
Well, I wouldn't use individual stocks for that barrier. What I would do is I would use a mutual fund or an exchange traded fund, something that's already diversified.
Right.
Because individual stocks has individual idiosyncratic risk. However, a mutual fund generally trends. And when you have a trending mutual fund or ETF, and if you can figure out where, if you're in the market when you're wrong, and get out when the system tells you you're wrong, then it's easier to, or more likely to, avoid some of the larger losses in the markets.
Is that what you call the moving average?
One of them is called the moving average.
And define that.
Well, if you take, for instance, the average price of a mutual fund over, let's say, 20 months.
Okay.
If the price of the mutual fund is above that calculated price, that means their fund is going up. in general, and it's relatively safe to be in the markets. However, if 1 month we calculate that moving average and it's above where the mutual fund is, then the markets are relatively dangerous at that time, and it's a good idea to get out while our losses are still minimal.
And so you have put this into practice, and you've used this theory now for a number. How long have you been investing actively?
I've been actively investing since 1995.
Okay, so 20-some years. So it really has worked out for you.
Yes.
So much to the point that you've acquired significant funds that you can semi-retire, and on top of that, now you've created the Wealthy Doctor Institute, and you're in business to help invest for others or guide others in their investments.
Exactly.
And how's that going?
Well, as I said, I think, as a physician, when I was in private practice, I was approached many times by money managers who wanted to invest for me. However, whenever I asked them exactly how they invested, specifically how would they manage risk, how would they know when they're wrong to get out, no one could give me a straight answer. I believe that whoever I'm helping is intelligent enough to understand how to invest effectively. So if all they need to do is read my book and they can start investing, that's great. If they need a little bit coaching or hand-holding, I can offer that as well.
You're there to do that for them. I was going to ask you, what's the reaction to the book been?
Well, as an author, it pains me to say that a lot of people don't actually read the book. They just see the book and they go, wow, you're amazing. However, there are some people who do read the book, and when they give me feedback, it's usually more like how I put in stories about how I developed the systems. I'm completely transparent. I don't put in just the successes. I also put in times when I failed or some mistakes when other investors
So I assume the reaction's been pretty good.
And they were really appreciative that I've been open about what I do.
I want to point out again, it's the Busy Doctor's Investment Guide. It's available at Amazon, at barnesandnoble.com, at Books A Million, and the website, by the way, your website is www.wealthydoctorinstitute.com, right? You can get the book there too.
Exactly.
Doctor, thank you very much.
Thank you.
Very interesting. Now it's my honor to present this prestigious award to Dr. David Yeh, the founder of the Wealthy Doctor Institute and the author of The Busy Doctor's Investment Guide, for the outstanding work he is doing to help keep America moving forward. Doctor, congratulations.
Thank you very much. It's been an honor.
That's it for another edition of Moving America Forward. I'm Bert Tenzer. Join us again as we continue to bring you the entrepreneurs who move America forward.
I'm William Shatner, and for all of us at Moving America Forward, thanks for watching.